are staring at a graph. It is 2 a.m. Third cup of coffee. Cold. And on your screen, just a line. USGBP since 1947, up, down, up, down. At first, you think it is noise, random, messy. But the longer you stare, the more it feels wrong. Too clean, like it was breathing, and that's the moment it clicks. What if the economy isn't just growing? What if it's oscillating? Boom, bust, a loop. That wiggle has a name, the business cycle. And once you see it, you don't go back and think the economy is just a straight line up. Today, we're going to follow that pattern, where it comes from, what drives it, and how you can see it before it hits. Because this isn't just theory. This is the closest thing the economy has to a pulse. And right now, that pulse is not exactly calm. Here's where things stop being a theory. Most people think the economy just grows, up and to the right, forever. Nice story. Completely wrong. If you take GDP and strip out the long-term growth, just remove the trend, what's left isn't random. It's a wave, up, down, up again, peaks, troughs, rhythm, and it's way cleaner than it has any right to be. Now here's where it gets uncomfortable. I took unemployment and laid it on top of that wave. Perfect mirror. GDP goes up, unemployment falls. GDP drops, unemployment spikes. No lag, no delay, just reflection. It looks fake, like someone engineered it, but it's real. We can measure it. There's a number for this, correlation. It runs from -1 to 1. 0 means no relationship. Positive means move together. Negative means move opposite. GDP and unemployment, -0.85. That's not kind of related, that's locked together. So no, the cycle isn't a vibe. It's measurable, repeatable, relentless. But here's the catch. Not all relationships are this clean. Some hide. Sometimes it's not the level that matters. It's the change. Things don't react to where you are. They react to how fast you're moving. And sometimes two variables only make sense because of a third one quietly messing with both. Which is why most people get stuck. They look for obvious links. The economy doesn't reward that. It rewards timing. Because the real edge isn't knowing what's happening now. It's knowing what happens next. And for that, you need lag. You need a lead. You need asymmetry. If something moves before the cycle, you can act. If it moves with the cycle, you're just watching. And watching doesn't pay. Okay, so the cycle exists, but why does it exist? Let me give you the short version, because the long version involves a lot of economists arguing in carpeted conference rooms, and nobody wants that. The engine looks like this. Credit to growth, to inflation, to interest rates, to credit. That's it. That's the loop. Banks lend money. People spend it. The economy grows. Prices start rising. The central bank panics and raises interest rates. Borrowing gets expensive. Credit dries up. Growth slows. We get a recession. Then rates come down, credit opens back up, and we do it all again. Round and round. It's like a casino, except everyone has to play. Nobody fully understands the rules, and the house is the Federal Reserve. The funny part? The relationship between interest rates and inflation wasn't even properly understood until the 1960s. We'd been running this loop for centuries without knowing how it worked, which is, great. This is where it stops being interesting and starts being useful. Not all indicators are equal. Some tell you what's happening. Some tell you what already happened. And a few, the rare ones, tell you what's about to happen. Those are the only ones that matter. We call them leading, coincident, and lagging. But honestly, only one of those pays, leading. Here's the trap most people fall into. They look at something like unemployment. It lines up perfectly with GDP. Beautiful, clean, useless. Because it moves with the cycle, not before it. It tells you what you already know. That's not insight, that's a mirror. Now compare that to something like the stock market. Messy, emotional, kind of chaotic. But it moves first. The S&P 500 shifts about 3 months before GDP does. Housing starts about 6 months ahead. The yield spread, long-term rates minus short-term rates, also around 6 months. And when that thing flips upside down, recession has a habit of showing up right on schedule. Then there's money supply. M2 leads by roughly 9 months. Quiet, boring, but early. And early is everything. These are signals, not perfect, not always right. But they move before the wave, and that's the whole game. Because if something moves after the cycle, you observe. If it moves with the cycle, you confirm. But if it moves before the cycle, you act. That's the difference. And right now, some of those early signals are starting to blink. The business cycle isn't a solo act. It's a room full of players, each one pushing, pulling, guessing, getting it wrong in their own special way. Let's meet a few of them. First, interest rates. If there's a villain in this story, it's them. Almost every downturn starts the same way. Rates go up, not by accident, on purpose. The central bank is trying to slow things down. Cool inflation, tap the brakes, and it works too well. Borrowing gets expensive, credit tightens, spending drops, and the whole system starts to choke. Next, stocks. Fast, confident, a little delusional. They move early, they react before the data shows anything, which makes them look smart, until they panic for no reason or rally into a wall. They're forward-looking, but they're also emotional, which means they're right just often enough to be dangerous. Then there's gold. Gold doesn't trust anyone, not governments, not currencies, not soft landings. Sometimes it moves years ahead of the cycle, which sounds impressive, until you realize it might just be reacting to something else entirely. Fear, uncertainty, noise dressed up as signal, and then bonds. Quiet, serious, no drama. When bond markets move, they're not guessing, they're positioning. When short-term rates climb above long-term rates, that's not normal. That's the system bending. It's the market saying, we think this doesn't last. Growth slows, rates come down. Something breaks. Bond traders don't need to be smarter, they just need to be right once, when everyone else is late. And that's why, when bonds start acting strange, people who understand the game stop talking and start paying attention. Here's the part nobody tells you. Correlation isn't stable. You run the numbers, you get something clean, 0.44 for oil, 0.40 for rates, 0.63 for imports. Feels solid, feels real. Then a few years pass, and all of it shifts. Same variables, different story. Because this isn't physics. There's no constant hiding underneath. It's people, millions of them, making decisions based on what they think other people will do, which depends on what happened last time, which was probably wrong. So the relationships move, they stretch, they collapse, they drift, and sometimes they disappear completely, not because they were fake, but because something else stepped in, a third variable, a fourth, something you didn't even know to look for. That part is humbling. You build a model, clean, elegant, convincing, and then reality changes the rules. A shock hits, a crisis, something your model has never seen, and suddenly it's not wrong, but it's irrelevant. That's the game. The economy doesn't break your model, it just moves on without it. All right, real talk. Look at the data right now. Industrial production, flat. Housing, stalling. Rates, still high. And the cycle itself, rolling over. You've probably heard the phrase, soft landing. Everyone says it. Like if you repeat it enough, it becomes true. If that worked, recessions would have been canceled years ago. But the signals aren't exactly comforting. The yield spread is flashing. Credit is slowing. The forward indicators aren't pointing up. They're hesitating. Does that guarantee a recession? No. Could be a slowdown. Could be a pause. But the cycle doesn't wait for confirmation. It moves first, and you either move with it or after it. Which brings us to the only part that actually matters. What do you do with this? Because there are patterns. Not perfect, but usable. When rates are rising and the system is tightening, that's usually when bonds are cheap. That's the window to buy. When the cycle turns and rates drop, that's when bonds get expensive. That's when you sell. Same with stocks. Near the peak, things feel amazing. That's usually your exit. Near the trough, everything looks broken. That's usually your entry. Not because it feels right, because it's early. Even currencies play the game. Some lag the cycle, some move ahead of it. Different timing, same logic. You're not predicting the future. You're positioning around the wave. Because the cycle doesn't care what you believe, it just runs. And if you're paying attention, you don't need to be right. You just need to not be late.